in our opinion, it's always a good time to be a multifamily buyer, but these blips in time, are in fact blips in time. They're very short in nature, so we really want to take advantage of these opportunities. So if you're a capital allocator or an investor, really right now is the time to prime the pump, to get ready and to deploy money into the market today, and probably for the next 24 months, it's pretty solid. If you look at historical cycles, we're probably in a great time to invest right now.
Yeah, I think the window won't be as big because I think Fed action will compress the window of opportunity, because we know that once the Fed steps in aggressively by lowering rates, investor sentiment's going to strengthen and liquidity is going to come back to the market very strongly. And once there's a ton of equity in the market, that's going to bid up pricing, right, and bid out the return premium that is currently available today. I mean, the way things are swinging wildly for Treasury volatility is really impacting when it is a good time to buy or not. Right now is quite competitive, actually. We're recording this in March, but towards the end of last year, in November, December, there were no buyers in sight. And if there was a seller that was looking to make a deal, they were not going to get a great price because there just wasn't a lot of bidding competition. So it's even just on a kind of quarter-to-quarter basis right now, things are just very choppy. I don't think we're really just kind of going on a smooth descent, find the bottom, and then smooth ascent. It's very choppy right now, and that's kind of making it difficult for everyone, us included, to find good deals. But I think we're going to transition to talking about a very interesting topic.
Yes.
Speaking of good deals.
Yeah, well, I don't know. I guess I'll lead the way, because we might have two different things.
Well, did you want to talk about affordable structures?
Yeah, well, no, we'll get to that at some point. So we're smoothly going
Okay.
back to what's going on with the market, the economy, good indicators, and rates being cut. I wanted to speak about the Pensford letter that just came out, which was very interesting. It was talking about the jobs and what's going on there. And what I found very fascinating, and I think we've spoke about this before, as of our friends, with regards to the job market and what's really going on there. And seemingly, yeah, there's a lot of job openings and such for, Taco Bell and gig-based jobs. And what the job report showed is that actually the new jobs were actually part-time jobs, and it was actually a lot of people taking up second and third jobs. So I believe that was kind of some of the subject matter there, but I would love to hear your thoughts and what your takeaway was from the Pensford letter. And by the way, if you're not reading the Pensford letter, on a weekly or whenever it comes out basis, which it's slightly sporadic.
Monday mornings, mostly.
Yeah, it can be, but sometimes he misses a couple of weeks, understandably so. It's not like he's getting paid to do it directly,
Right.
but it's really a wealth of knowledge. I really encourage you all to subscribe to the Pensford letter. It's really like the Bible for Lone Star to kind of read. I think everyone in the firm, it's almost mandated that you must read through that, at least if you're on kind of the capital market side like we are. But be curious to know your kind of thoughts and takeaway with regards to what the most recent publishing was. I know that it'll be not the most recent when this is released, but in regards to kind of the job market, what was going on there, and kind of the indicators we're seeing in this market cycle.
It's a frustrating topic because since I subscribe to the Pensford letter and agree with what is said in there, right? JP, the author, and we agree and are just frustrated by the headlines versus what we believe the actual data to be saying. The headlines are, we have a red hot labor market, the economy is super resilient in spite of all these interest rate increases, right? And the issues I take with that are, number one, the lag effect. When rates are increased, it takes 12 to 18 months for the real economy to feel that. What does that mean? That means that we are still waiting to experience the full brunt of where rates are today. That is point number one. Point number two is you have to look under the hood about the unemployment data and the job gain data. First of all, it sounds criminal, but it's true. Pretty much every single month for the last 13 months, the headline job report comes out and says, oh my gosh, we added 300,000 jobs, it's amazing. And then a month later, the BLS, I believe, the Bureau of Labor Statistics, revises down the job growth estimate by like 120,000 jobs or 160,000 jobs. So, but the headlines go out and people run with it. And then that gets circulated in the media. And I guess, even though the bond market is very sophisticated, I guess it does trickle into the bond market, right? And if people see these headlines of super strong job growth and CPI, then they're going to sell off bonds, and that makes treasuries higher, right? And it's just a volatile thing, because on a month-to-month basis, people are following what's the month-over-month trend for CPI and for job growth, because they're looking at job growth very closely, because they're looking at that as an indicator for inflation, and they're looking at that as an indicator for positive momentum in the economy. And to your point, you mentioned a couple factors that the Pensford letter pointed out, which are, okay, some of these jobs are really just a function of people adding more part-time work. So if one individual has 3 part-time jobs, that counts as 3 jobs in the market.